Hello and welcome to the latest Insider interview. Our guest today is Simon Gergel, manager of the Merchants Trust. Simon, thank you very much for coming into the studio.
Hello.
It's been a volatile start to the year. We've seen interest rates hit 5% in the UK and lots of worries about the economic outlook. So how have you been managing the portfolio? What have you been buying and selling?
Well, it's been yet another volatile period in markets, as you hint. And one of the flip sides of that volatility, or one of the benefits of the volatility, if you like, as an investor, is it throws up opportunities. So firstly, the UK stock market is quite cheap compared to its history and compared to other markets. And secondly, within the market, there's a huge dispersion of valuations. So there are some companies on quite high multiples and many others actually really cheap compared to history. And that's throwing up lots of opportunities for stock pickers like us. So we found, a number of companies often in the more cyclical areas and the mid-cap areas. That's where we're finding the best opportunities at the moment, because the larger companies tend to have more of a following. But I suppose one of the other things that's happened is you've had money going out of the market. People have been selling, which has again put pressure particularly on the domestic companies.
And can you give some examples of companies that you've bought this year and companies that you've sold this year?
Yeah, so a company that we bought earlier in the year was a company called Pets at Home, which is well known as the UK's leading pet retailer of pet products and accessories and food. But they also run a vet business called Vets for Pets, which is a joint venture. And that combination of businesses is really powerful. And it was one of those businesses that was quite depressed in the stock market because people were concerned about the outlook for retail spending. But actually, people spending on pets tends to be very resilient. People will prioritise pets a lot above many other areas that they're spending. And also over time, people are spending more and more on their pets, giving them better health care, better food, better nutrition, treating them more as like members of the family. So you see these quite powerful long-term trends. So we see that business as quite well positioned in the medium term and not as cyclical as the market was implying. And we saw a good opportunity early in the year to buy that business at a sensible price at that time. So that's one example of something we've been buying. In terms of selling, we had a company called BAE Systems, which is the UK's largest defence company, in fact the UK's largest manufacturing business, but also has a really strong presence in America and elsewhere. It's been a really successful investment for us over the last 2 or 3 years. Clearly defence spending is going up significantly, partly because of the troubles in Ukraine. And that's led to a re-rating of the shares, and they've moved from being quite modestly priced to being, in our view, quite fully priced, or at least we no longer saw much upside. We're quite disciplined on valuation, and so we sold that to fund some of these other areas.
You said there that the UK is very cheap at the moment. Can we put some numbers on that? How does it compare to, say, US or global shares? And what's the reason that it's cheap, and what could be the catalyst for it becoming more fairly priced?
Yeah, the UK market's trading on about 10 times price earnings ratio. It means you pay £10 for every pound of profit, and that's a substantial discount, something like 40% discount to the global average. The US will be at the higher end and Europe at the lower end. What's driving that? A number of things. I think ever since the Brexit referendum, there's been a bit of uncertainty about the UK, particularly from foreign investors. There's been political uncertainty, although we think that should become less of a feature going forwards, because Rishi Sunak and Keir Starmer, who might become the next Prime Minister, their policies aren't a million miles away from each other in the way that maybe Boris Johnson and Jeremy Corbyn's policies were a few years ago. So I think the political risk has been one factor keeping people out of the UK. I think the other thing is that there's been a concern since Brexit about how the UK economy would fare, and actually the UK economy has not done that much worse than other economies. Unemployment's remained quite low. The economy's trundled along. It's not been high growth, but it's been okay. So I think those have been two of the main features in the UK market to depress sentiment. And then we just had a lot of selling by institutions, pension funds, insurance companies, but also individuals, which has just led the UK to be even cheaper, I think, and out of favour. But I think all of that is an opportunity. I suppose the other final thing is COVID hit the UK pretty hard. Just as we were coming out of the uncertainty after Brexit, COVID came along. So there's been a succession of issues that have hit the UK and made people cautious. But in many of those, we think are working through the system now and should gradually reverse, hopefully.
The trust yields 5%, and you fish in the higher yielding pool of shares in the UK market. Are there any high yielding shares that you like and think pay a stable dividend, but the market is perhaps a bit more worried about?
There are quite a number actually. If you look at the energy companies, they've got high yields but really strong cash flows. The banks actually, having been through 15 years of difficult period for the banks with a succession of things they had to do. They had to rebuild their balance sheets, had to take leverage down, take debt down in the system. They had to pay lots of money for PPI claims, you probably remember, and also pension funds. There were lots of calls on the cash of the banks, which meant that they weren't, although they were generating profits, a lot of that was being absorbed. They're now generating lots of surplus cash. They're starting to pay significant dividends and buying back shares. And with interest rates rising, actually that's generally quite positive for the banks. So that's an industry where you've got very high yields, and we think those are sustainable. But there's many other individual companies in the medium-sized area that actually are good businesses with strong business models, sound balance sheets, where dividends do look pretty resilient. Yeah.
So can you give some examples of those under-the-radar dividend payers which investors at home might not have heard of but actually present really good income investing opportunities?
Yeah, I mean, it's comes back to some of the areas in the building products areas. We've got a company called Inchcape, which is a car distribution company, quite an unusual business. What they do is they are effectively the manufacturer's agent in certain markets. So, for example, Inchcape has been looking after Toyota in Hong Kong for 50 years. They are effectively Toyota in Hong Kong. They bring the cars into the market. They provide them to the retailers. They do they work with the aftermarket, spare parts, and they work in over 40 countries for a large number of different brands. Half their business is now in Latin America. So it's quite a diversified business. And these relationships are really powerful. Once a manufacturer, a brand uses you in one of their markets, they tend to stick with you. It tends to be quite resilient. And it's not like car retail where the profits can go up and down a lot. Distributing cars, you're taking a fee on bringing the car in and all the services you're providing. It's a good margin business. It's quite profitable, and they are generating a decent amount of cash, paying a dividend, which we believe should be sustainable. You never quite know in investments. There's always things that can happen, but that's an example of a business that isn't that well known, but actually is a market leader in what it does. It's the leading company in that industry, but it's listed in the UK, but it's actually a global business. Very, very small amount of its sales and profits are coming from the UK, actually.
And what's the yield on that at the moment, more or less?
It's around about 5%.
Gearing is a feature of investment trusts. It allows you to borrow to increase returns. So what is the gearing in the trust today, and what is the policy around gearing?
Yeah, so the simple idea is if you can borrow money and you can get a better total return from the investments you make than the cost of that borrowing, then you can enhance the returns you make for shareholders over time. And so we have a modest amount of gearing or borrowing. The borrowing in merchants is about 14% of the NAV, of the net assets. We have a range of 10 to 25 at the time we draw down debt, and the gearing is a decision for the board. So probably worth saying, investment trusts have independent boards of directors separate from the manager who make decisions about issues like gearing, but they're comfortable with 14% gearing, which will hopefully enhance returns. It also allows us, because of some technicalities, to pay a slightly higher income to shareholders. But of course, it also adds to volatility. So when markets go up, gearing should help extenuate those returns. But clearly, if markets go down, gearing can amplify those returns on the downside as well. So investors need to understand with investment trusts, if you have gearing, it can amplify returns in both directions. But if our cost of debt is 4.5%, if we can make more than 4.5% in the long term on the portfolio, then the gearing should be beneficial to shareholders.
Do you think the role of gearing will change now that interest rates have risen so much, because you have to make more money when you invest the money that you borrow, or do you not see that moving too much?
It might change over time. I mean, 2/3 of our debt is fixed rate, so we've got a 30-year bond with a 3.5% coupon. So our average cost is 4.5%. It's gone up a little bit because some of our debt is floating, but most of it is fixed. And therefore, it's going to take a long time for rising interest rates to feed through, because we've got one bond which matures in 2029 and one in 2052. So it's really going to take a while to have an impact. But yes, at the margin, you might find that investment companies that are borrowing money on floating rates might take a different view on gearing over time.
And finally, the question we ask all of our guests: do you personally invest in the trust?
I do. I've got a significant amount of my own money in the trust and the other funds that I manage.
Simon, thank you very much for coming to the studio.
Thank you very much.
And that's all we've got time for. You can check out more insider interviews on our YouTube channel, where you can like, comment, and subscribe. See you next time.